Investors are concerned about the epidemiological situation again. China, with its zero-tolerance COVID-19 policy, has reported new infections. This means the country's authorities may well impose tougher control measures, which in turn will lead to lower energy demand by China, the world's biggest energy consumer. In addition, the risk increases in the face of a looming recession. Major central banks continue to fight high inflation by raising interest rates. However, this results in more expensive loans, thus hindering business development. At the same time, a steeper drop in oil quotes is limited by the uncertainty about energy supplies to European countries ahead of winter. Notably, the European Union is set to stop buying all Russian crude oil delivered by sea from early December. A sharp fall in temperatures in Europe will only increase energy wasted in heating homes and contribute to rising natural gas prices. In addition, investors are mulling over the news that a major US liquefied gas producer is forced to delay deliveries to Europe as it has failed to resume operation at full capacity following an explosion and fire erupted at its export terminal in June. Obviously, sanctions targeting Russian energy will be very costly for Europe. From a technical point of view, Brent crude oil dipped to $90 per barrel after sellers broke through the support level of 92. To extend the downtrend, the price needs to first fix below the 90 mark and then hit 87.5, the low posted on October 18. In theory, this could add to short interest in the market. Meanwhile, gold remains relatively stable, although the quote pulled back down from $1,780 to $1,755 per ounce, and it still has a chance of resuming its upward cycle. In addition, Bloomberg analysts predict that the volume of long positions on gold could increase sharply in the near future. According to them, a subsequent rise in gold prices could level the volume of transactions of the ETF GLD exchange index, the largest gold-backed exchange-traded fund, which still does not reflect the recent increase in gold prices. As for a bearish scenario, the price needs to fix below the $1,750 mark on the daily chart. Aggressive interest rate hikes by major central banks remain a negative factor for the yellow metal. Yesterday, St. Louis Fed President James Bullard suggested that the federal funds rate could reach the 5 to 7% range next year. Besides, San Francisco Fed President Mary Daly said that it's not yet the time to step down from large hikes. Nevertheless, analysts assure that the economy cannot but react to such drastic steps and is expected to slide into recession in the near future. This, in turn, may lead to a resumed rally in gold prices. Experts say that the Fed's first rate cut could push the metal up by 20 or even 30%. Likewise, the ruble remains stable despite the results of the OFS Treasury bond auction. At the moment, the level of 60 rubles per dollar is seen as an obstacle where the price has formed a sideways range. So it remains only to monitor the price behavior near this level. If the price rebounds from it or breaks through, it will be possible to determine the pair's next move. And that's all for now. We wish you profitable deals. See our channel with a new video in a couple of hours.